We're gonna start this again because everything I've said up to this point has been deleted, wiped. I zoomed in and looked up the video, and that's fine. Okay, now just to not confuse you, we're gonna go and start from the basics all over again. Now, here's how we start. The first two things that you need to know are what the candles are. A green candle means it's bullish. That means price is going up. A red candle, like this, means it's bearish, and that means price is going down. These two are very important because this is what the fundamentals are about. And I'm going to teach you the fundamentals in the order you should be learning about them, not in the way I went about it, because really it's a journey. And if you learn about it the wrong way, it's going to make you get a lot of losses, which is a problem. And it's something I had to deal with. But if you learn about it the right way, then you're probably going to be better off than me. Next, we're going to go and look into different types of candles. Now, the candles that really matter here and the ones that really make an impact are specific candles, right? Number one, a strong candle. Like one of these are like spikes and strong breakout candles, right? It's a strong push, strong push. It really enforces that the movement is going this way, but never follow through on that candle because there's a good chance it can reverse. So again, you wait for confirmation. We're going to look into that in a bit, but let me just break that down. Number two, preferably a candle like this that's in the middle. It hasn't decided whether it wants to buy or it wants to sell. That is what we call a doji. Stay away from those candles. Don't even like look there. Don't even interact. These are the kids you just keep away. These are the uncool kids. You stay away from them because you don't know whether they're gonna crash out or whether they're gonna be friends with you. Just keep your distance. Like stay away as far as you can. Don't do nothing about them. Don't do nothing with them. Now, the one that I really like are these candles. Now, I don't have a term for them, but based on the place I learned it from, we call it the John Wick candle, right? That means that essentially what this means is there's resistance from a certain point. Now, if you see the stop line being longer than the bottom one, that means sellers are in play. Sellers are pushing the price down and down. That means your sell position is still active. But if I have to find a candle like this. But okay, this one counts as well. But if you see the bottom line being stronger than the top one, that means buyers are in play. That means there's a potential buy coming up. But again, all of these variables that I'm going to talk about, they're variables. Like you need to have a checklist of all of these taking out to ensure you have the best possible trade setup and the best confirmation to ensure that your trade is probably going to be a winning trade instead of it being a losing trade. So this is another variable that you look at before you enter the trade. Now what we're going to talk about is, and I'm going to go back to the trade that I was explaining in the beginning of the video that just got completely obliterated. What we're going to look at are these terms. Now, in order to get those, I'm pretty sure there's a lot of indicators that would do it, but the one I rely on, by the way, it's not supposed to be intended to be used this way, but shout out to this guy. He did it because his thing helps a lot with confluence. This is called the Omar Nowick candle, right? Essentially, I'm not going to go into a strategy because it's better if you learn from him and see if you're going to figure it out yourself. But what I use it for are these marks. So the lower highs, higher lows, lower lows, higher highs, change of character, and break of structure. Now I was explaining this straight over here. Let me just break that down. So you have two options. One is a short and one is a long. Now depending on the trading firm you're using, depending on whether you're using a live account or a prop firm, you have different um, platforms to use for trading, right? And TradingView is just a place you can monitor the charts from and you take the actual executions because I take my trades on MT5. So that's a separate platform and you can't really do all these on that. So this is what I use to ensure I have my trades set up right and then I enter it on my phone. So now you have two options. Here you have a short, here you have a long. What a long means is price essentially is looking to go up. Okay. Now, what a short means is you're saying the price is going to go down, right? You're saying the price is going to go down on a short. Now, a short would be a sell, a long would be a buy position. A short or sell is normally enforced by a strong red movement. A buy is enforced by a green movement. That's as simple as it can get. Then you have, which is a key important subject of matter, take profit, entry, stop loss. Stop loss is a certain loss you can set and ensure that you do not incur a loss more than that. And a target, TP, is that's the profit you're trying to aim for, and that's the profit you're aiming for. And then the entry mark is wherever you entered. So let's explain what lower lows and lower highs, change of character, higher lows, what these are. This is another variable that you're going to have to look at before you take your trade. Now we're not going to look at this trade because that now you know like that's the trade I would have recommended. But let me explain why we're looking at this trade the way we are. Again, mind you, this is something you should not just blindly enter because higher time frames are the deciding factors. So every one of these higher factors decides if this trade is going to play out the way it is. You don't know if price is really going to push all the way up to that level. As you can see, it didn't because you don't know how the higher time frames play around about this. And another rule that you need to enforce is that you have to wait for candle closure for confirmation. Now, what I mean by this is look, now we see a strong bearish momentum down. Bearish again is a sell. You see prices going down and down and down and down. But now you have a downward candle. That means buyers are starting to resist this price and they're trying to push above. Not only that, the next candle is a strong push green, and then it is red, but candle closes above this. So if candle had closed below this point or below this point, I would have not entered this trade. I would have said, خلاص, trade is invalidated. Don't enter. Do not do anything with this trade. When you look at that candle, again, it's scaring you, but you wait for candle closures. Again, I would not enter the trade at this point because we only have one, two, three consequences so far. Nothing is confirmed. Still a lower low. You see price pushes up all the way to this lower high forms. Again, lower high, that means, oh shit, potential sell is still active because the lower low and the lower high, it's not looking that good because price failed to break above this zone, right? Now, you see price is starting to reverse, but this candle closure didn't break below this point. That means a higher low was formed. So now you have a higher low, you have a green bottom wick, less candle, a bullish momentum, okay, a weakening sell, okay, and you're entering. You don't enter yet. Then price decides to push back up. That candle closes, you have a change of character. Now, how I could explain the change of character is, let's say price is pushing back down, but it starts to push up. A change of character often means that there's a reversal. So now, as price is pushing back up and it doesn't push back down and it closes here, change of character means you're looking at a reversal and price action is pushing upwards. Same over here, like you can see, there's a change of character over here that's pushing downwards and it closes. You wait for a candle close. There's always a timer that says, oh, these many minutes, these many seconds left before candle closes. So you wait for candle closure. You wait for a closure that says, oh, change of character, and then you enter. You can enter, and I think change of character is based on this candle, so I wouldn't enter there. I would enter there. Yeah, I would have entered there after this candle closes because normally these change of characters are still forming and it doesn't completely form. Again, this is not a trade I would take. I would take this one. I'm just showing an example. So now you have a change of character, you have higher low forming, you have a weakening sell, and a fairly bearish bullish momentum going up. Now the next candle opens green and it's marked by the work. I enter. I put the stop loss below the change of character, and I target the mid zones. So instead of waiting for a straight reversal to try to target these highs over here, I'm just going to be happy with how much money I can get. Normally I target 25 to 26 a day. And the max loss over here is 17, and that's completely fine because normally it's always like a 1, because at the beginning I would target 1 to 3, 1 to 4, 1 to 5 ratios. That means for every $1 I risk I get 5, very unrealistic. You're not going to find those kind of setups every single time, so it's best you take a good one-to-one, because there's a better chance that trade hits than you trying to push for something higher. Now I'd wait for this setup to play out. Let me just show you what this would look like on replay. Let's get to this candle, right? So we're just gonna slow this down, put it on 1x. Ooh, let it play. Candle's forming. Oof. Candle closure. Change of character formed. Okay, this is closed, but essentially it would have been fluttering around that range. So I would enter. I'd put it below the high low, and now watch how this plays out. Price pushes up, pushes up, pushes down, pushing up, pushes down, pushes up, pushes down, pushes down, pushes up, up. Okay, now here's where I would. So I told you there's a stop loss, there's an entry point, there's a take profit. Now what you can do is, when you get to a position like this, when you know price is failing to break below, you either try to make your your trade risk free, or you either try to make sure your trade gets you out with some profits. Now normally a lot of people, what they do is they layer their entries, so they, instead of entering once with one trade, they enter like 5 6 times, and then they move stop loss break evens, and then they get out at certain profits, and then certain profits, and then certain profits. Now you're okay with doing that if you're willing, if you have a lot of capital back, then you don't have certain consistency rules. But I use a prop firm and I have a consistency rule, so I have to stick to it. At this point I would move the stop loss to break even, or I would move the stop loss above to these higher lows. So essentially that would mean, if I have that there, my, I don't know why I can't do it here, but let's just go without it. Okay, so essentially I'm looking at an active profit of $4. Okay, I would have put stop loss there. Breaker structure is still active, by the way. I would have walked away with $5 or $0. Either ways, I would have taken some profit out on this trade. Okay, price plays and plays and plays, and then it hits TP. We are out on this trade. Trade has been hit. Successful trade. Now that's one part of the trade. Next, we have the change of character covered, break of structure covered, lower highs, lower lows. It's the same way it works, the same way on shorts. But again, you see over here, we don't have a lot of lower lows and lower highs forming. That's confirming it's not a strong movement, but you could enter this if you want a quick scalp. Now, the ones you're trying to avoid, okay? Never, 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 never make an entry unless you have something confirming that yes, I want to enter at this point. Okay, part two. I had to close that one just to make sure we don't get cut off in the middle. Now we enter the next part of this. Now in a day, you have 3 sessions. Okay, we are going to avoid this one because market closed and we had a Juneteenth holiday, so just stay away from that. You have the Asian session, which you stayed up away from. Never, never, never. Asia, you can never trust the Asian session unless you have mastered the living shit out of it. And I'm telling you, it's very hard. Unless you take some time and you focus specifically on that, and then you learn eventually. But again, it's best to stay away from Asian sessions. You don't know how things are going to go. And again, I see a lot of setups in the Asia right now, but that's hindsight bias. That's confirmation bias. That's saying that, oh, markets have already formed their position. And I could be like, oh, I missed that trade. I could have entered this trade like over here, like, because look, I see a change of character. And by the way, I have a no trading zone. Thanks to Ahmad Novik, I don't enter trades at those times because there's a lot of market spillage. Market closes, opens, it will hit stop loss. Never, never enter those. Like you see a change of character here. I could enter. I could enter. I could put stop loss below higher lows over here. Take profit would have been the mid zone. Ooh, see, like because there's a, not only that, there's a bigger structure too. Higher highs, higher lows, higher highs, higher lows, bigger structure, movement still going on. But we're not going to talk about that. Asian session is in the morning. stay away from it. Then, so according to Qatar time, that's gonna be London. Um, London opens around like 11 a.m. But again, I don't start on the London open hour. I let structure form out a bit before you take trades. London open, then you have the New York. Now London, New York, and by the way, this one gives you New York open, New York AM and PM, because there's New York open, there's New York lunch, New York. I don't know what the third one is, but there's three or four New York sessions because of this indicator. It's called the ICT kill zone. You have these three sessions. I recommend you trade only on the London and the New York and stay away from Asia and the ending of New York, because you do not want to trade around that time, because market really tries to die down around there. So don't even keep open positions at that point. Okay, now here's where this gets interesting. Okay, now you see this trade I had opened here, and by the way, let me tell you, even if you take a prop firm, do not take the trades on TradingView, because number one, there's a lot of slippage. That means, okay, so there's two prices. Number one, you have a buy current bid price. That price of gold right now is at 4155, but ask price is like a secondary, like mimic. That's like the actual price of what gold is. So there's like a gap that follows through every single time price goes up and down, up and down, up and down, and you really have to set your stop losses according to that. But normally, because of the slippage, there's like a small gap. So either you could win more accidentally or you could lose more accidentally, just to be safe. That's why you don't enter during these, because if market closes and opens, it's going to fill and it's going to slip out. You don't know how those slips work, so it's best to just stay away from them. Now let me explain what I was about to explain. Shit, I got distracted. You have the Asia high, you have the Asia low, you have the London open low, you have the London open high. Now I had this trade open, but I exited early because, again, I was looking at 1 minute because of the noise. I was really trying to get a win because this was Juneteenth. I wanted to see if I could have a winning day on that day, and I was really trying to push for trades, so that was just like scalping. But you see, my setup was playing out. It's just I was a bit too early to it. Now, for starters, you see London Open High has tapped the Asian lows. So London Open Low filled up to the Asian lows, opened up, London Open High, pushed back down, straight to the Asian lows. It tapped into the Asian lows. Now there's a good probability it would have hit London Open High, which is why I had this trade open on my trading view just to see how that would play out. And as you see, it did hit the London Open High. But you see over here, you see this momentum I've targeted. I'm targeting the Asian high. But now that I look at it, the way I think it's gonna go is it's gonna hit the London Open low. So the next point of movement is going to be tapping into that London Open low, and then tapping into the New York AM high. So I'm not quite sure if it's going to hit the Asian high anymore, but I think that's how the movement is going to go. Either ways, I don't target the max highs anyways. As you can see, my take profit is below the Asian high. So again, I think that's how the movement is going to go for the next week. We can see how that plays out, but I think you get the point. I think you get the point that I'm trying to explain here. That's part 2 of the strategy I use. Part 3, you have fair value gaps. Oh, what a beautiful. Okay. Now, when I say confluence means it's confirmation. Like, it's multiple variables. It's like a checklist. You're checking out this, and this. So you have. So far, I gave you these indicators: lower lows, lower highs, change of character, break of structure. Let's put that all into one confluence. Then I gave you the session highs and session lows. Next confluence. Number 3, I gave you what was the next confluence? Directional confluence, but it's never like the biggest factor, but it's a part of it. You can use it, but never put it at the top of your list. That's 3 right there. Number 4, right? Now we're gonna look into fair value gaps. These are a little interesting. Might be a bit complicated. because there's a lot of explaining that goes into it. As I said before, never make trades on the 1 minute time frame. You're going to make trades solely of the higher time frames. So the higher time frames decide how it's going to play out for you. Like you see that upward momentum on the 15 minute would have just confirmed the 5 minute trade that I recommended to you, because you have the London Open highs, and then you're trying to fill the Asian sessions. Regardless, again, it's a mid zones. That was a beautiful trade. I could have taken it that day. Shit, I kind of regret not taking it, but it is okay. It is okay. It's part of life. It is what it is. Okay, back to what I was explaining. Now, what I'm talking about is a fair value gap. Now, what a fair value gap is essentially a gap between two candles. There's no FVGs here. That's interesting. No, there is an FVG here. Okay, but it's too crowded for me to explain it. Guess we're gonna go to 15 minutes and try to explain it if it's there. Does it show? Okay. Oof, why are they so crowded, bro? Right. Okay. I think this might be a really good one to explain. Now, you have a fair value gap. All right, it's a gap between one candle and two candles. Like you see, those two candles have a gap in between. Now, what these gaps normally mean is essentially it's a magnet. That means price is essentially, you have a very good probability that price is going to fill into that gap at some point later on or not. Now, what you do is, specifically looking at this example based on everything that I've taught you so far, you have an Asian high formation here. Now price is resisting at that point. It's breaking below. You have a fair value gap that has formed here. Okay, you have a what did I delete? Oh, okay. You have a fair value gap that has formed here. Now price. Now here's where the big guns come into action. Number one, here's how you determine what trades to take. Now a fair value gap becomes invalidated. Basically, it means it's useless. Your trade is invalidated. Now you wait for the next setup to show up. If price breaks above, like it doesn't push back down, it just pushes straight above. That means, khalas, your fair value gap is dog shit. It's useless. You don't even look at it. Stay the fuck away from it. Ooh, we have a big fair value gap there. It hasn't filled to 50%. I think we're gonna push back up soon. Anyways, back to what I was explaining. Now, again, as I told you, candle closure is very important. We're on the 15 minute, so we potentially could take this trade on the 15 minute too. Adi, it's still a good setup. Now, you have a lower high forming. There's a higher low, but there's a lower high forming there. Okay. Number two, you have a higher low, right? Then price pushes back up. That's a rejection, by the way. Price tapped into it, but rejected. But I would not enter yet. Next few candles have happened. Price still taps into it, rejects, closes. Okay. Now, realistically, as I told you, you need as much confirmation and confidence to enter trades. Now, I could take a gamble on this and be like, yo, you know what? We have lower highs forming. There's a breakup structure. I could enter right there. Mind you, that's not a loss I normally take. I put it above the Asian highs just to make sure that I don't get swept out. And I see a big fair value gap here that we're looking to fill. Okay, because that is also looking to fill. But normally, we don't target the fair value gap on the top or the bottom. Okay, so don't specifically look for the top candle, the top fair value gap, and the bottom. You go for the mid zones, and even on each of these fair value gaps, you try to get out your profits as early as you can within the fair value gap, because you don't know if it's going to break below or break above or reject. So normally I aim for the 50% range of the fair value gap, or somewhere around 35 to 40. So I get out at that range. Okay. Now, it could have been a gamble. Good thing it worked out. Mind you, that's a good reason too. You know, you're putting stop loss is really good. It's above the lower high and the Asian high. And now is that interval between Asia and London. and you're targeting, you see three fair value gaps, you're targeting the mid zone, and in the mid zone of the mid zone, to me, that's a good trade. I would not even bat an eye to it. But personally, what I like to see is over here. You see this. This could have gone completely wrong, by the way. Price pushed back up. Okay, it tapped and it formed a higher high. But when this higher high formed, it's a red candle formation and it's a strong push down. That would have been the final confluence because you're entering around at the same range. As you see, the previous entry was around there. Entry would have been somewhere around there too. I would have waited for that to happen, and then I would have entered realistically, and you could have walked out with a good profit. So that's what fair value gaps are. Now, and by the way, if you see that setup, there's a good chance you'll find the same setup on the 5 minute. So normally I use 30 minutes, 4 hours, 1 hour to tell me what the direction of the day is looking like and like what we're looking for, potentially whether we're looking for sells. Because now when I look at the daily, okay, when I look at the daily, I see breaker structure, I see lower lows forming, I see sells for the next few days. We're not looking for buys until we get to this point. And keep in mind, you have to look at geopolitical news. Um, so essentially, anything that puts the value of the US dollar up means the gold goes down. But if a US dollar goes down, that means gold goes up. That's another factor you can take into account here. And again, geopolitical news is playing a big hand here. So for the next week, I'm still looking for sells. The market is suggesting sells, but I'm still looking for sells because the Strait of Hormuz is closed, which means we're still looking for sells. I think, yeah. No, I think we're looking for buys. It depends. It depends. Really, you have to look at what the US dollar position looks like. If the US dollar is strong, gold is weak. If gold is strong, that means the US dollar is weak. So again, it depends on how the news plays out. But a lot of news factoring into this. Right. Okay. So now we've covered fair value gaps. We've covered time zones. We've covered session highs, session lows. We've covered lower highs, lower lows, higher lows, change of characters, and break of structure. Now, the next and final thing that I have, actually, there's another one that I use, but I have that turned off while I develop the algorithm. But let me just turn this video off and start again so that we can explain this fresh. We are now getting to the final part. Okay. By the way, all of this is not financial advice. Mind you, there's always a risk at this. So please actually study and look into what I'm saying. Don't just blindly follow. Understand these terms the way you want to, and then use this as support. Because quite frankly, I'm new to this as well. So this is gonna take a while. This is a journey. It's gonna take a while to actually get to those profits. But you know what? It's a step-by-step process. You're not going to get the big money instantly the same way you see it because all those people have been trading for years and years. They've been in the game for what, like 5 6 years. Some people get lucky, but then they lose it all. Again, you really have to study and understand it the way you understand it. Now the next part that I'm going to look into is an order block finder. This is the final piece in the strategy that I've learned this week because every day my strategy gets refined, and it gets better and better in terms of understanding how the market reads are actually going. Because week one, we only used directional structural bias because I saw, oh, price went up, now it's rejecting, so it'll go down. Next, we looked, then we had supply zones. I actually haven't gone into supply zones and consolidation. Okay, we're going to do that after this. And then we had the Asian highs, Asian lows, the kill zones, and then we had what did we have? Then we looked into fair value gaps. Then we got into order block. Again, it builds over time, but I'm giving you the code and the structure you should be following. And so far, alhamdulillah, it's potentially working for me. We still don't know. We need to see a good payout first, and we need to see consistent win rate. So far, my win rate is around 53 to 55%, I think. So it's a process, and I've only done this strategy for 3 days. Um, so 3 days, 55% is not bad. Um, 53%, mind you, that's a build up from all the previous strategies I've been working so far. So if we're doing 3 days, I think we're looking at 100% win rate. So let's see how this works out. Inshallah, it goes really well. Now we have order block finders. Now, what order blocks are essentially same thing as fair value gaps. There are certain spots that will get tapped into. They're like support zones. You're gonna wait for price to tap back into it eventually at some point. It's the same concept you use for fair value gaps to see if price is going to tap into it or break below it. Okay, so let's see. Because mind you, with this indicator, it doesn't actually give you the order block as soon as it forms. If it did, chef's kiss, you could have gotten a lot of profits, but it doesn't work that way. I only use it as support zones for price to potentially tap into it. Um, that's it. That's all I do. I wait for those zones to get hit, and then we look to take trades. Now the problem is for me to explain this example, I am looking for a support order block. Only issue with that is if price breaks, because I think there was an order block here. There was a bullish order block here, but it got closed because price broke below it. Alright, عادي. We're gonna still explain how this works. This is gonna be a bit difficult to do so because we don't have a lot of order blocks to support it, and actually show you that this is how it works. But you know what? I think it's doable. So let's look at this one here. Again, interesting one. Should have taken. That's two trades that I've missed. And now that I look at it, it's like could have taken these. Okay, now you have an order block here. You don't get told there's an order block here unless price hits there or somewhere here. But look at this. There's a fair value gap. Price pushed below. Okay, fair value gap forms over here. Now price taps into it. Again, now you have an order block here. Look at this. There's an order block right there. You have a fair value gap right there. Now look at what price just did. Price, again, lower lows, lower highs, change of character, change of character, change of character. Okay, remember that. Put that in your head. Change of character. Price pushed down, candle closed above the rejection, rejected the fair value gap. So price broke down, retested, rejected, is pushing back up. Okay, so mind you, as soon as the fair value gap forms, there's a good chance it doesn't always like get tapped into instantly. But you have a lot of confidence over here. Again, if you've actually paid attention to what I've showed so far, you will understand why I'm telling you there's enough confidence for me to take an entry right at this point or take an entry right at that point, which I recommended from the beginning. But mind you, this was perfect. This was like an A+ setup. I confirmed that shit. I could have taken that trade. Hadi. It's okay. It's okay. It's life. You can't really control how life goes. But what you're gonna do is you're gonna open this XAUUSD on your trading view. You're gonna look at it. You're gonna put all these indicators on. It's a free game, mind you. If it was anyone else, they'd probably hide their indicators because a lot of people, what they do is they hide it. They're like, "Oh, DM me, follow me, and then I'll give you the indicators and shit." I'm telling you, take it, take it. You make money, I make money. We're still learning. It could probably go completely wrong, go completely right. It's a learning curve, learning process. We all are meant to get rich together, so let's do it. Okay. So if you've learned everything and you've paid attention to what I've taught you so far, you're going to justify and you're going to tell me why this entry point is for sure a really, really good long position. And you're going to do it yourself. You're going to look at it. You're going to look at all of these factors and do it yourself. So we covered fair value gaps. We covered order blocks. Okay, we haven't finished order blocks yet. Now, not only does price reject from that order block. Okay, there's an order block here. Normally what you can expect is price will eventually tap into that order block. Okay, and then you have another order block there. So you always target the freshest order blocks. Okay, normally it doesn't get that in that early, but it did, and that's okay. Out of your hands, nothing you can do about it. Now, what could possibly happen here is, as I mentioned, there's a certain potential trade that I'm looking at in terms of how things are going to go. Right? I told you we're going to try to target the London open lows. Price is going to push back down to there, and it's going to push back up to London open highs or New York aim high. So essentially, what we're looking at is with order blocks, it's the same thing as fair value gaps. You confirm, wait for a retest, you wait for a rejection. Order block formed, price is retesting. Now, essentially, it could candle close and push straight back down, which is what happens a lot of times, and you just have to bank on that chance. Or you wait for price to push back up, get that liquidity swept. Now, preferably, just to be safe, I would have a stop loss above the New York AM high in case I'm looking to go for the sell. So I would expect price to tap into that New York AM high, okay, and then break out, and that would be my entry point. So at that point, I would have taken a short, put stop loss above New York AM high, and take profit right close to the London open low. Never target the direct spots. It could push below, mind you. It could tap right into the 50% range over here, and it could tap beyond this. But just to be safe, get your profits out early. Rule number one. I mean, actually, the biggest rule: get as much profit as you can. Manage your trades. Risk margin matters a lot. You can keep pushing the stop loss down. Once price perfectly breaks below here, and you can put the stop loss down. That's another trade. I'm just gonna leave it here just to see if that's how structure plays out. Eventually, I'm looking for that to happen. Okay, so we've covered, we've covered the markings. We've covered IFVGs and fair value gaps. We've covered kill zones. We've covered order block finders. That's pretty much what I use for now. If you do have any questions, comment down, bro, or just text me, bro. Like I can just do it for you. I can explain it. And again, we're learning together. I'm hoping that once you learn these things with me, we can essentially, pinpoint what areas we have here, or we can take the trades together. We can build a community. Anything is possible. The sky is the limit. Essentially, this is what we have for now. If there's anything that supply zones. Okay, consolidation. Okay, so what does consolidation mean? And now, when you look at the 1 minute time frame, now you understand so many markings. It's mine. Stay away from it. Okay, never rely on the 1 minute time frame unless you're looking for quick scalps. Because there's so many change of characters, so many bigger structures, you don't know how things are going to play out. Because look, there's a change of character there, there's a change of character there, and there, and one there, and then one there, and then one there. It's the same thing as it being a breaker structure, but just reverses back and forth, back and forth. It's just going to confuse you. Now, I think that counts as well. Let me just mark that out. Okay, so essentially what consolidation means is price is undecided. The market doesn't know if it wants to go up, nor does it know if it wants to go down. Okay, price could go all the way up. For all I know, it could go all the way down, but you don't know things unless market decides it. Okay, so again, we're retail traders, we're not institutions, so we don't have a Bloomberg terminal. We don't see all the things they see before entering the markets themselves. But let me just explain what this means. Yeah, that's one, and I have one marked there. So if price is moving sideways, okay, it's not a clean breakout above or a clean breakout below, stay away. Do not enter trade at that point. Now over here you see price broke out and then tapped back straight in. It's going sideways. And again, you wouldn't know this is a consolidation. So essentially, I think this is where it starts. Okay, price is pushing down. It's saying it's going down. Okay, it's actually saying it's going down. There's a change of character. There's lower high, lower low, but you don't know if price. Because if this starts to happen, let's say I did enter a short position at that change of character, exactly at that change of character, I would have entered right above that change of character. Take profit would have been the mid zone. So again, there's consolidation over there. Price is moving sideways. I target the 50% range and I get out at that price. You see consolidation over here. Price is breaking below it. Candle closed, candle closed. Price is not tapping back. So what that means is you're good for the sell. And then, mind you, this is a big gap. So it's at that supply zone. So supply zones were essentially what my current order blocks are. I expect price to tap into each of them before going either ways. So you see there's a supply zone there, price pushed back up. And I could have technically entered a sell at that point because I know price is going to tap back into that supply zone. And it did. But it didn't really have a good win rate because there's a lot of other confluences that you're supposed to look at. But if you're strictly relying on supply zones, that's just not going to get you enough. So it's best you actually include everything to try to get a maximum edge on how the trades play out and if you want to be profitable. Again, entry on 5 minutes, confluence from from the day, from the 4 hour, 1 hour, 30 minute. And if you're going to constantly track your trades, I recommend you have the same trades open as the same way you have it on your phone. You enter on the 5 minutes, but you track on the 15, and then you keep going back and forth between those two. That was long. That was a long video. But essentially, this is all it is. This is all that I can go for now, or I can explain now. Oh, coincidentally, yes. Wait. No. I need to. You're gonna look at this now. I'm recording. I'm recording the video, and I'm doing the whole tutorial. So wait. I'm gonna edit the video. I'm gonna put it up on YouTube, and then you can watch it. Okay. Just wait. Just wait a bit. I'm recording the video. All right. Okay. So I would recommend you practice your trades. You paper trade. Paper trade is basically you're not trading with actual money. It's like demo accounts. Now what you do is you trade. You can trade directly on TradingView. You can just put these long and short positions open, close. If you really want to understand how this works, but if you want to get your hands on with all of this, what you're gonna download on your phone is MetaTrader 5, MT5. That's the platform I use to make my trades. Now you can use a demo account on it. Only problem is, actually, there's no problem. Yeah. You can use MetaTrader, and you can do the same thing so that you can feel like get the habit of having taking the trades simultaneously as you're watching TradingView. You have both the ways you can go about it, and you should see at the top right of my screen. You should see my upcomers code. If you want to use the same prop firm that I'm using, you can get into it. I think the sale is still open. The choice is yours. You could go with paper trading, start off, and then use a prop firm. And I'm using them currently. So far, I've enjoyed my time with them. I haven't had any complaints yet. We're going to see how that plays out once the payouts start to come and how they are with their payout system. But I use upcomers and I use Rebels funding. Either ways, you can use the link. I'm going to leave the link for getting into that prop firm in my comment section. And if you want to get into it straight away, and if you think you've learned enough, then feel free to use the link and get. I think you should be able to. You should get like a 90% discount. Yeah, you're probably gonna get a 90% discount. Yeah, I think that's it for the video. Yeah.